to this special live stream edition of Money Talks, coming to you live from the Seedly Personal Finance Festival 2025. I'm your host, Andrea Heng. Now, the US and China, they are back at it again, trading blows in a tit-for-tat tariff war, sending the S&P 500 falling by just over 2%. Just to give you an idea of how bad it is, that's the biggest drop since April this year. Remember Liberation Day? Now, with all of this volatility in the markets, it's easy to feel like, let's just pull out my money and hide it under my mattress or my pillow because that's where it feels safe, right? But let me throw a question back at you. Could chaos present new opportunities? Apparently, it is possible. Today, we're going to break down how to turn turmoil into long-term profit. To guide us through this, we have the founder of Steady Compounding and one of the speakers here at the festival, Thomas Chua. Welcome, Thomas. It's great to have you on the Money Talks live edition.
Hey, thanks for having me, Andrea.
Now, it's good to have you, Thomas. Now, before we get started, to all of you watching online, if you have any questions for Thomas, just leave a comment wherever you are watching us from, and we promise we will get to them during our conversation. So, Thomas, what do you think of that headline? Threats of tariff hikes between the US and China. I mean, you're no stranger to investing during a tumultuous market. What was the largest impact, the largest drawdown that you ever saw in your own portfolio?
Yeah, so Andrea, I think that's a great question because when I look at what Trump is trying to do to the China at the moment, whenever he does a tariff move, it is always not the end. It is always just a start to a further negotiation. And I think as investors, what we are seeing in the stock market, whenever there's a volatile moment, it is when the biggest transfer in wealth happens in the stock market from those who are short-term oriented to those who are long-term.
Right.
Yeah, and back to your question on what is the biggest drawdown I've ever seen. I think the biggest drawdown is during 2022. When the stock market started drawing down during that period. But whenever I see something like this, I look at my own portfolio. It makes me nervous. But at the same time, when I look at the stock market, there are clear opportunities out there, and that's what gets me very excited. Because whenever I look at all this volatile period, I think back to even during the pandemic, when the world goes into lockdown,
right,
and everybody was very worried about travel stocks.
Yeah.
Right? Like Hertz was going bankrupt, Thai Airways was going bankrupt, there's just so much turmoil that investors wipe out the whole travel industry.
Yeah.
Yeah. So during 2020, we saw the stock market draw down by 28% within a couple of weeks, and the travel industry dropped by almost double that. Right.
Wow.
But during those moments, while it's true that there are some positions that are extremely dangerous, we are not sure whether they'll survive. There's this other opportunity that I saw that was very, very interesting, and that's Booking Holdings, which should be very familiar to a lot of Singaporeans out there, because Booking Holdings is the owner of Agoda.com, right, Priceline, Booking.com, OpenTable, so on and so forth.
Okay.
While they are the largest lister of hotel inventory in the entire world, they don't own any single one of them. They are basically a platform that consolidates supply and demand. And all the hotelers, they have to deal with mortgages, they have to deal with the building maintenance, airlines have to deal with the planes. There's a lot. It's a very high fixed cost business, and that put them at very high risk of going to bankruptcy. But when it comes to Booking Holdings, it is simply a company that most of its expenses are in advertisement. Right, it's running Google ads, it's running ads on Instagram and Facebook,
right,
which could be turned off just like this overnight. Lots of cash on its balance sheet. And that's where I felt like, the company dropped by almost 50%.
Wow.
But when I ask myself this question, the long-term investor question, is this company going to survive 5-10 years down the road? The chances are very high because its expenses can just be trimmed down to bare minimum overnight. And you and I both know that most people love traveling, right? And traveling isn't going to be disrupted or changed, right? And so that was when I took a position in that company, and during moments like this, volatile moment, opportunities are there for the long-term investor.
It sounds like it. Now, back in April 2020, you wrote an article on your blog, Steady Compounding, about how to invest better during market crashes. We did a call out on Instagram before the live stream event and asked our audience, what's your biggest fear? Several people responded saying that they fear or they are afraid of losing everything, and that's a very familiar feeling to many of us during COVID, especially in 2022. Now, Thomas, we know that with investment comes risks. How would you respond to that fear that some of us have?
Yeah, so I mean, that's a great question because it is only human to fear something like this. And one thing I always like to do is that before I start investing, I always write down my investment thesis, right? I want to crystallize my thoughts before the market starts getting volatile, because when it gets volatile, that's where our irrational thinking usually starts to kick in and our rational thinking goes out the window.
Yeah.
So we always want to write down why we own this company in just simple language. And we also want to make sure we don't invest in money that we would need, over the past 5 years,
Yeah.
over the next 5 years. Because when we do that, we start to have a lot more nerve-wracking moments when investing through the stock market.
Well, that's the thing though. Not everyone has the time or the patience even or the inclination to write this thesis, right, that you have. How do you then stay invested and prevent yourself from panicking or panic selling during such times?
Yeah, so like I think for most investors who are just starting out, I mean, the best way is always just go back to look at your credit card statement over the past few months, and then you try and identify whichever products you have been a frequent consumer of, right? If you are always buying this product, even though it raised prices and it's a very recurring product, chances are you find a pretty good idea there that you could potentially understand, and that would reduce the amount of effort it requires for investors to do their research, and we don't always have to go for the most sexy name or the most complicated names, whether it's Tesla or whether it's Nvidia or TSMC, for example. There are always consumer brands or just brands that we are a consumer of that we could understand very, very easily.
Yeah. Okay, so you are not a fan of dividend stocks, but you are a big advocate of finding compounder stocks. So for our audience, could you explain what a compounder stock is and why it's such a powerful engine for building wealth over a period of time?
Yeah, so basically a compounder stock is a company that's able to reinvest their earnings and turn that $1 into $2, $2 into $4, $4 into $8. And the beauty of these compounders is because they are able to find opportunities to reinvest their earnings.
Right.
They do over the most of the heavy lifting for us. And one of my favorite examples is that for a very long time, Starbucks was able to reinvest, at 25 to 35 return on capital, meaning like every new store they open up, every new Starbucks they open up, they will achieve break even in 2 to 3 years. And when I own a company like this, and if it's back in the days whereby they just started, they have a really, really long runway, and that's when they will do over the heavy lifting for me, right? Without me having to lift another finger, the company will just continue to expand, grow more stores, come up with more drinks, and when they grow their earnings, so will the stock price.
Right. And we would look for this in terms of how they spend on research and development, for example.
Yeah, so I think that's a great question because research development is one of them. Marketing is also another one of them.
Right.
But more importantly, I think when it comes to investing in these companies, qualitative assessment like what gives the company the right to keep raising prices is also one of them. Right? And also thinking about, how much more of this product can they sell. If they're only in 5 cities right now, for example, then obviously the runway is a lot longer.
Yeah.
But, if they are already saturated, then, then we have to taper our expectation as to how much more they can grow.
Yeah, there's such a thing as you've grown too big to fail. Now, I understand that you are now managing your portfolio full time. But here's the reality, Thomas. Not everyone has the luxury of time to manage their own portfolio full time. How can someone who may not have this luxury of time analyze prospective investments quickly and efficiently to identify some of the key fundamentals that you spoke about when it comes to compounder stocks? Because we don't have time. We're rushing all the time. What are the top 3 things we need to look out for to say, okay, this is a good compounder stock, I'll buy in?
Yeah, I love this question because this is directly pertaining to the book I just written. And the truth is not all stocks are the same. Some stocks would require you way more attention. It requires you to follow it every now and then. But there are companies that are way stronger that don't demand as much attention. So if you look at a company like MasterCard or Visa, right? If we were to buy them 15, 20 years ago, we could have gone to the beach and not look at the financial statements again.
Yes.
Right? Because that's just how strong a business these 2 companies is. And so like when I think about this, I mean I love that question because whenever we think about investing strategy, it's not just about making the most money, but we have to think about a strategy that's sustainable for the investor as well. And the truth is, many of us have jobs, many of us have children, many of us have, 1,001 things that pull us in different directions.
Yeah.
So the one thing that I would pay most attention to when investing as a busy professional, right, is why does this company deserve to be bigger 10 years from today? Right?
Oh.
Because whenever we think about investing, the stock price is going to track the fundamentals.
Yes.
And the question on why it deserves to be bigger 10 years from today will answer a few things, right? The growth levers. Is the company able to grow in a very sustainable manner?
That's right.
And secondly, does the company has a unique competitive advantage that can let it stand out against competition and survive over the next 10 years? Is it in an industry that's resilient enough to let it survive that long? Or is it in an industry that's always getting disrupted? Then we want to steer clear of this company, because as busy professionals, we don't have time for all this drama.
But is there such a thing as too unique as of a stock, right? I immediately think of Tesla and the kind of cult following it tends to have when it comes to its stock. And it's come down, it's gone up, it's swung so much, right? And I mean, we're not going to get into why it swings so much, but is there such a thing as a stock that is too unique, a company that is too unique on its own, that is isolated?
Yeah, so Tesla is that's a very interesting question, because there are stocks that are way more stable than what companies like Tesla, or even in the private market, the most volatile.
Because I think you were talking about your stomach, right? I think that to be invested in a Tesla stock requires a very strong stomach.
Yeah, because the range of outcome is especially wide. It depends on whether we want to think about it as a car company, or is it, autonomous self-driving is going to happen.
Right.
If any one of them happen, the divergence in value is going to be very big. And the key to owning a stock like this is through position sizing. That means we own enough for it to matter, but not so much that it causes us to lose sleep.
Okay. Yeah. Another asset that a lot of people tend to flock to in uncertain times is gold. So we have a question from Nancy who sent this earlier. Gold is rallying well now, and if I'm not wrong, my last check was gold prices are hovering at the 4,000 mark. That's insane. I didn't think it would reach 4,000, but there it is. Is it time for us to do a bit of a reshuffle, take the safe haven approach while all of this volatility is happening?
Yeah, so that question my parents has been asking me also. That's when I know gold prices has become extremely hot. And gold definitely is having its moment right now. But here's the thing, when I invest, I always look at productive assets, because when I want to, all investing involves a certain level of forecasting, looking into the future. And when I invest, I always want to think about, how much cash is this business generating? But for the business of gold, they don't generate any cash at all, right? It's very much depending on supply and demand. So if we want to invest in gold, we have to think about what supply and demand would look like. And historically, the biggest driver in demand for gold has been the Chinese government, the India government, and also the Russians.
A lot of central banks.
Yeah, mostly central bank driven. And when I ask myself, do I want to be in the business of trying to guess what the central bank is trying to do? I think that's a very, very tough game to play, right? And the truth is, even when I look at the past 2 years, China has actually been slowing down their gold purchases as well.
Yes.
Yeah, so for me personally, I like to stick to my lane. I like to look at businesses, and when there's volatile moments, then that's where, I try to go in and look for all these gems.
Okay, we have one more question from a viewer. Graham, if the market is volatile and I am risk averse, should I turn to fixed deposits or even put my money into my CPF because the interest rates are more stable? And indeed, this is something that I've talked about on the Money Talks podcast as well as on radio as well. Is this the time to turn to FDs, CPF, SA, for example?
Generally, when it becomes extra, but that's me. When it becomes very volatile, I become very excited for the equity market. But that's just how I feel, because that's when a lot of opportunities will come. But everybody's risk appetite is going to be slightly different. I think CPF is definitely one of the very safe instruments we can go for. Interest rate has been coming down steadily. So, I would always approach it with a diversified approach. And, you have to structure how much goes into equity and how much go into this more fixed income like investments. based on your unique risk appetite. And usually when you are a new investor, it generally helps to talk to a professional or something to try and determine where your risk appetite is and come up with a strategy that you are comfortable with.
Okay. Let's talk about investor psychology now. It's one thing to understand the logic of holding for the long term, but it's quite another to stay calm when you see prices plunging.
Yeah.
What is your number one tip for investors to manage their emotions and stick to their strategy?
I think the number one thing is we have to have a diversified portfolio, right? I mean, for me, concentrated stocks within like 3 to 5 stocks is definitely a no-no. Another thing is I always want to make sure that the amount of cash I invest into the stock market today is not cash that I need going forward, right? But the most important thing, I would think this would make or break most investors, is that do you really understand what you own? Right, if you were to own companies like Palantir or something like that, I'm quite sure most investors don't understand what these businesses are doing.
I know, and they hear the name Palantir and like, oh, that's cool, I must be buying that.
Exactly.
Yeah.
I mean, I don't think they really understand, what the economic mode or what the business model or what's driving these earnings. And when you are going through the stock market like this, it's like going into the jungle without a compass, right?
Yeah.
And you're going, exploring the world without a map, without a compass, without no GPS, right? So, I mean, the key thing to surviving through all this turbulence is that you only invest in companies that are within your circle of competence.
Yeah.
You really understand them.
Fantastic parting words. Thomas, it's been great to have your insights on the Money Talks podcast. Thank you so much for joining us today.
Hey, thanks for having me.
That's all the time we have, unfortunately. And thank you out there to our live audience here at the Seedly Personal Finance Festival 2025. And of course, to everyone who tuned in online as well. That's you. Now, if you missed any part of this or you want to share it with your friends and family, the replay will be available on CNA's YouTube channel. Money Talks is available on Apple Podcasts, Spotify, YouTube, and Me Listen. Make sure you are subscribed so you never miss an episode. Big thanks to the team, as always. Tiffany Ang, Nat Fetalvero, Junaini Johari, Ho Pei Ning, Joanne Chan, Hanida Amin, Reza Abdul Rahman, Lim Lee Ting, Shamil Sapari, Norfaiz Samhari, and Alison Jenner. It's a big team to put this all together. Thank you so much for tuning in. I'm Andrea Heng for the Money Talks podcast, and this has been a special live edition of Money Talks.